It is Ryan Seacrest here. There was a recent social media trend which consisted of flying on a plane with no music, no movies, no entertainment. But a better trend would be going to ChumbaCasino.com. It's like having a mini social casino in your pocket. Chumba Casino has over 100 online casino-style games, all absolutely free. It's the most fun you can have online and on a plane. So grab your free welcome bonus now at ChumbaCasino.com. Sponsored by Chumba Casino.
No purchase necessary. VGW Group. Void where prohibited by law. 21 plus. Terms and conditions apply.
People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost for many folks over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
Good morning and welcome to the Safe Money and Retirement Show. I'm your host, Jon Heischman. Several weeks ago, my show focused on living past age 90. I got quite a response after that show aired. I think because it made a lot of listeners realize there is potential to live past age 90, and we've got to plan for that. That would have been the April 5th show. And if you want to listen to that show, you can go to my website and it will direct you to past radio shows. That website is HeischmanFS.com. HeischmanFS.com. That stands for Heischman Financial Services. So visit my website and take a listen to past shows. And as always, if there is a particular subject that you would like to discuss with me, or if you have any questions, we don't have to meet in person. We can talk on the phone. So let me know. Here's the number, 888-426-0177, 888-426-0177. I like to receive your questions and concerns, so let me know. Now, if you want to call me direct at my office, it's 614-861-7055. I have a question. Can a retirement portfolio be too aggressive? That depends on age. And that statement applies to retirement planning, which is typically where you're past the accumulation stage. That's the first stage of 3. You've got the accumulation phase where you're working, you're contributing to your 401k and possibly your IRA. You're accumulating assets. You want to be aggressive because you've got time. The next phase is the preservation phase. You have built and accumulated retirement assets. You're looking towards retirement, and you should be looking at preserving these assets because you're going to go into phase 3. I call that the distribution phase. Retirement income, required minimum distributions that you're going to have to take from those qualified retirement accounts. So I don't want you to be too aggressive in that preservation phase because it could affect the distribution phase. And as I talked about 2 weeks ago, if you live to age 90 or past 90, that income has to be there. Being aggressive has the potential for higher returns, but also greater investment risk, making those portfolios susceptible to market downturns approaching or in retirement. I don't think your portfolio should be too heavily weighted in aggressive stocks, especially nearing retirement. It's important to review your portfolio to make sure you're in line with your objectives and timeline. One option is to take a look at rebalancing your investments and considering an annuity, which can be a powerful tool to help stabilize and potentially reduce a retirement portfolio's overall risk. If you have the right annuity, there is no risk. Annuities offer options and guarantees that make them popular with retirees and investors nearing retirement. I think that's the big reason for the substantial growth pretty much each year over the last 10 years. Not only are the guarantees attractive, but the lifetime income benefit that can be included in that annuity is huge. Another big advantage is they offer tax-deferred growth, which is really a plus for high net worth individuals near retirement and in retirement who are most likely in their peak earning period and tax-paying years. But you have to understand that no one size is going to fit all solutions or situations. There's many types. I mentioned guaranteed lifetime income. That could be a fit, which it is for many retirees. Others are interested in the guarantee that there is no risk. The question is, how much are you going to earn? Or, as I've seen, a combination of both. One very popular type of an annuity is what we call a fixed annuity, which pays a guaranteed compound interest rate for a period of time. I can give you a good example. Today, there is 6% compound interest guaranteed for 3 years. Of course, this rate can change tomorrow or next week or next month, which companies do, but I've seen this rate stay pretty steady over the last month. And as mentioned, it's tax deferred, and it is a great place to park money that you don't need and you want the guarantees. They can also be used for IRA money as well. Then after 3 years, you decide where you want to move the money if the rate drops at that time. Another type would be a variable annuity, which offer potentially higher returns, but also have risk. There's a menu of investments similar to a mutual fund, and income can be generated from the variable annuity. You're going to have your indexed annuities, which are going to fall somewhere between a fixed and a variable as far as return, with no risk, and typically used, from what we've seen, for income using the guaranteed lifetime income benefit. So if you delay taking the income for, let's say, 2 years or 5 years, the account can grow in value, and the longer you wait to start the income, the higher the income amount is going to be. But the most important thing is to make sure that an annuity is right for you and what type is in your best interest for your situation. There are many of the old annuities that are outdated and haven't adjusted to change. So one option is to review the annuity or annuities you have and to see if combining them to a new one is in your best interest. I can help you with that by doing an annuity review and also to talk about, is that right for you at this point in retirement or even pre-retirement? 888-426-0177. That number again is 888-426-0177. We also want to look at your risk tolerance, comparing that to a portfolio that might be too aggressive for your risk tolerance. Are you in or approaching the preservation phase that I talked about earlier, and making sure that you can preserve enough of your retirement savings to make sure it's going to give you an income that you're going to need through retirement? And I say income, I should say guaranteed income, just in case you live past age 90. As always, I hope I've given you something to think about and to take the necessary steps to make adjustments. I'm going to take a short break at this point, so stay tuned for the second part of the Safe Money and Retirement Show.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
You have spent your entire working life hoping what you put into your retirement accounts will help you live comfortably in retirement. Hope has no place in retirement planning. Hope can make retirement feel like a looming problem instead of a rewarding life stage. I don't want to operate under hope, especially today when longevity is at its highest. That's a good thing, but it's a problem when we talk about retirement income. You need a well-executed plan. This is Jon Heischman from the Safe Money and Retirement Show. I can help if you'd like to schedule a telephone conversation or a face-to-face meeting. Call 888-426-0177, 888-426-0177.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the Safe Money and Retirement Show. I'm your host, Jon Heischman. The first segment of the show this morning, I was talking about how your portfolio was balanced and how much risk is in that portfolio. and I say portfolio, this is a combination of accounts that you have that is going to provide you income during retirement. And along that line, I want to review with you a very important risk in retirement. It's called sequence of returns risk. Many are thinking about risk lately, especially those that have just retired, because sequence of returns risk becomes a danger as an individual takes withdrawals from a particular account or multiple accounts. And when I say withdrawals, this is for income. The order or sequence of annual investment returns is a primary concern for retirees who are living off the income and capital of those investments that could be subject to sequence of returns risk. Earlier in the show, I talked about annuities, where the fixed annuity and the indexed annuity does not have any risk. So we don't have to worry about sequence of returns risk when we're discussing, or if a retiree has those types of annuities.
It is Ryan Seacrest here. There was a recent social media trend which consisted of flying on a plane with no music, no movies, no entertainment. But a better trend would be going to ChumbaCasino.com. It's like having a mini social casino in your pocket. Chumba Casino has over 100 online casino-style games, all absolutely free. It's the most fun you can have online and on a plane. So grab your free welcome bonus now at ChumbaCasino.com. Sponsored by Chumba Casino.
No purchase necessary. VGW Group. Void where prohibited by law. 21 plus. Terms and conditions apply.
Sequence of returns risk applies to those accounts that you have, whether they're qualified or non-qualified, that have risk, because the danger comes when that retiree receives lower or negative returns due to the withdrawals that they're taking for income. Long-term average returns and the timing of taking those returns can impact not only future income, but the value of those accounts. Financial outcomes can be dramatically different depending on when and how a retiree begins to take withdrawals. Issues like the state of the market, and if it's a bull market or a bear market, are not under the control of the retiree. However, retirees do have some opportunity to limit the downsize risk. I see a lot of those that are getting ready to retire, putting off retirement, working longer when there is volatility, or planning with a worst-case scenario regarding rates of return. If you've delayed retirement and continuing to work, making contributions to the retirement plan, whether it's an employer-based plan or maybe it's your own individual IRA, it can help offset losses, or it might be time to diversify away from higher risk stocks, which obviously has a tendency to fluctuate in value based on the state of the market. It all comes back to having enough money coming in to provide a consistent and guaranteed income during retirement. Remember, I talked about preservation, keeping the money that you accumulated prior to retirement. Why does sequence of return risk matter? Because the sequence of returns that you're getting may significantly impact the income available during retirement. Two retirees with identical wealth can have entirely different financial outcomes depending on the state of the economy when they start retirement. Even if the long-term markets average are the same, incomes are affected, reduced during multiple years of a market downturn. Let me give you an example. A retiree that's entering retirement at the bottom of a bear market will see the prices of their holdings in their portfolio rise when the market recovers. More crucially, however, that retiree will also see a reduction in the overall return of his portfolio because of how much had to be withdrawn early in retirement when prices were down. Plus, this retiree is essentially withdrawing funds as his or her portfolio loses value. Consequently, that retiree would have less shares of equities, which can benefit from positive returns down the road. I don't want to see any retiree have to adjust their income because they're taking more out of their retirement accounts because there have been multiple years, especially in the beginning of retirement, when the market has been down. By contrast, someone who retires when the stock prices are high take early withdrawals of fewer equities because they are worth more, will likely have a higher overall portfolio return than the bear market retiree earns. Why is this? Well, it's because the bull market retiree has more equities left in the portfolio, which can allow this retiree to continue earning returns later in retirement, particularly during a period of strong markets. Continuous strong markets where you have growth keeps those income withdrawals strong and sets you up for increasing your income later on in retirement. You've probably heard somebody say in good markets that they recovered their losses. If you have an account that's worth $100,000 and you lose 20%, now that account has a value of $80,000. Then there is a 20% gain. You've gotten your money back, right? Wrong. Because that 20% loss that took you down to $80,000 now gets a 20% gain. It's 20% of $80,000, which now takes your account to $96,000. That 20% gain still puts you at a $4,000 loss or behind where you were when it was $100,000. Now, let's say you're taking income from that account with that scenario. Sequence of returns risk means what if you have 2 or 3 years in a row, especially early in retirement? Are you going to recover? And if so, how long? Because remember, you're depending on this money for income. How do we prevent this? Well, very simply, establish your income, your guaranteed income first. Then what's left over, put it in the market. Keep that money in there for the long term and hopefully benefit from the growth because it could be additional income later on in retirement. So your exposure to risk becomes very important. It needs to be addressed. And I want to be able to help you determine where you're at, how much income will your accounts generate? And most importantly, will that income be guaranteed? 888-426-0177. Once again, 888-426-0177. There's a couple of other risks that a retiree needs to address. I have a list of 13 retirement risks, and if you'd like a copy, just call the number I give you. But your retirement plan needs to address these risks. We've got the longevity risk, which I talk about a lot. Excess withdrawal risk. You're drawing down too much income compared to the amount of money that you have. Do you realize 4%, 4.5% is the recommended withdrawal rate? What happens when you're withdrawing 8 to 10%? There's a problem there. Inflation risk, tax risk, market risk, or long-term care risk where a nursing home stay starts to drain all assets, and that can end up being a lot of money. So as I mentioned, we want to talk about these risks. There are more than I just mentioned, but request your copy. I'll send it out to you immediately. There's no cost, absolutely no obligation. 888-426-0177. And keep in mind, retirement planning involves so many different components, not just growing your money or making money. And that's why it's so important to cover the entire retirement income planning process. I'm glad that you took the time to join me this morning, and I hope that you have received some new and informative information from me. Be sure to tune in next week at the same time, same stations, for the Safe Money and Retirement Show.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.
It is Ryan Seacrest here. There was a recent social media trend which consisted of flying on a plane with no music, no movies, no entertainment. But a better trend would be going to ChumbaCasino.com. It's like having a mini social casino in your pocket. Chumba Casino has over 100 online casino-style games, all absolutely free. It's the most fun you can have online and on a plane. So grab your free welcome bonus now at ChumbaCasino.com. Sponsored by Chumba Casino.
No